The Japanese economy was the biggest economic miracle in the 20th century after the United States. Here's a graph of Japan's gross domestic product (GDP) data from the World Bank. You can see that Japan's GDP was over $47 billion, with the latest data available in 1960. Yet just 3 decades later, the economy grew to a stunning amount of over $3.1 trillion by 1990. And a further growth was seen, where the Japanese economy peaked at $5.55 trillion in 1995. This was the very same year that caused many news articles to publish economic analysis about Japan, simply because it was catching up to the United States. Here's a comparative graph from the same source, the World Bank. You can see that the gap between the US and Japan was very small in 1995, where the US economy stood at just $7.6 trillion. This was a pivotal moment that led many to believe Japan was going to surpass the United States. Other metrics even already showed that Japan had catched the US. For instance, in GDP per capita, Japan had overtaken the US in 1987 and had seen a big gap between the two nations in 1995. This was indeed an economic miracle. There was no other nation globally, other than China, that came close to overtaking the US. But as many know, the story wasn't a happy ending. We saw the eventual stagnation of Japan's economy not for 1 decade, nor 2 decades, but over 3 decades. Since 1995, Japan has not grown at all. You can see that in this graph right here, as we extend the GDP of both Japan and the US. A lot of people have said that it's simply because of the Japanese asset bubble that caused the economy to stagnate. The asset bubble caused the so-called lost decade, where Japan not only saw stagnant economic growth, but also deflation and declining asset values. But there's more to this story than just the asset bubble. There's one more reason why Japan's economy has struggled to grow since these years, and some blame the United States for this. Here's how the US played a role in Japan's slowdown. These all started from the decades leading up to the 1980s. From the 1970s, Japan had established itself as a global manufacturing powerhouse, dominating industries such as automobiles, electronics, and machinery. These were the very same years that gave birth to Japan conquering a huge portion of the semiconductor industry and saw the rise of Japanese automotive companies like Toyota. The semiconductor industry was one of the most pivotal aspects behind Japan's rise, and had also played a key role in its stagnation. Here's a graph with data published by the Semiconductor History Museum of Japan. You can see that in 1981, 69.5% of the market share in 64 kDRAM was captured by Japan, with the remaining 30.5% by the United States. Japanese companies like Hitachi, Fujitsu, and NEC were market leaders in this category. But what is a 64 kDRAM, you ask, and why was it so important in 1981? Well, it was a type of memory chip, specifically a 64 kilobit dynamic random access memory, DRAM chip, which was a technological marvel at the time. DRAM chips are critical components in computing devices, acting as temporary storage that enables faster processing of data compared to traditional storage like hard drives. In the early 1980s, the 64 kDRAM represented the cutting edge of semiconductor technology, and its production showcased a country's ability to lead in the tech-driven global economy. It was in this industry, as well as others, that gave rise to a concept called trade surplus. Here's a graph from data that we collected from the United States Census Bureau, which shows the trade of both the US and Japan from 1985 to 2000. As you can see, the US has been exporting substantial amounts to Japan of billions of dollars. But at the same time, the US has also been importing massively, much more than they export to Japan. This has then caused a trade surplus for Japan and a trade deficit for the US. What this meant was that there was a significant imbalance forming between the two economies. Japan's trade surplus indicated that it was selling more goods to the US than it was buying, leading to an accumulation of wealth and foreign reserves in Japan. This trade surplus for Japan then became an important part of Japan's economic rise. You can even see that from their accumulation of total reserves as reported by the World Bank. From 1960 to 2000, they have gained a massive amount of total reserves, thanks to their strong exports globally and to the US. In the year 2000, Japan was even the world's largest holder of total reserves, with over $361 billion, a figure that far surpasses any other nation. The trade imbalance between the US and Japan had then become a source of political tension. American manufacturers, particularly in industries like automotive and electronics, felt increasingly threatened by cheaper, high-quality Japanese imports. As pressure mounted, the US sought a solution to rebalance global trade flows and reduce its deficit. This led to one of the most dramatic policy decisions in post-war economic history, the Plaza Accord. On September 22, 1985, representatives from the G5 nations, the United States, Japan, Germany, France, and the United Kingdom, met at the Plaza Hotel in New York City. Their goal was to address the overvaluation of the US dollar, which had appreciated by 44% against major currencies between 1980 and 1985. The agreement was clear. The G5 countries would intervene in currency markets to weaken the dollar while allowing other currencies, particularly the Japanese yen and the German Deutsche Mark, to appreciate. For the United States, this was a strategic move to make its exports more competitive and reduce its trade deficit. For Japan and Germany, it meant assuming a larger share of global demand by strengthening their currencies. Initially, the plan seemed to work. The dollar depreciated by 40% between 1985 and 1987, and Japan's trade surplus began to shrink. However, the yen's appreciation turned out to be far steeper than anticipated. By the end of 1985, the yen had surged by over 50% against the dollar, sending shockwaves through Japan's export-reliant economy. You can see how this played out in the official exchange rate as published by World Bank data. From 1978 to 1985, Japan's exchange rate to the US dollar was consistently trading around 210 to 249 yen to a dollar. Yet, by 1986 and further years, the yen had appreciated, falling to as low as 128 yen to a dollar by 1988. Do mind that these were just a couple of years, and a huge surge in a country's currency in such a small time frame was a recipe for disaster. Whenever a country's currency rises in value, this makes their products more expensive on global markets. This would then cut deeply into their profits. Here's a graph with data published by the World Bank. You can see that the exports of goods and services as a percentage of GDP in Japan was over 13.6% in 1985, yet it fell to over 9.4% by 1988. Here's another graph to depict its annual growth rate by year. In 1984, annual growth rate of Japan's exports of goods and services was over 15.4%. Yet, by 1985, it fell to 5.3%, then a contraction of 5% in 1986. This was largely because of the sharp increase in the yen's value. This contraction in the export sector had a domino effect, leading to a recession in the mid-1980s. Faced with this economic slowdown, Japan's policymakers acted swiftly, but their responses inadvertently laid the groundwork for future crises. To stimulate the economy, the Bank of Japan implemented aggressive monetary easing, slashing interest rates to historic lows. Here's a dataset published by the Bank of Japan for their interest rates. You can see that Japan's interest rates from 1983 to 1985 was over 5%. Yet, by 1987 to 1989, it fell to 2.5%. These interest rates were a response to the economic problems that the country was facing at that time. Then, on top of that, these were also accompanied by fiscal stimulus measures designed to boost domestic demand. While these policies succeeded in reviving growth, they also fueled speculative excesses in the real estate and stock markets. By the late 1980s, Japan was in the throes of an economic bubble. Land prices in Tokyo soared, and the Nikkei stock index tripled in value. At its peak, the value of land in Tokyo alone was estimated to be greater than the entire real estate value of the United States. For a time, it seemed as though Japan was on an unstoppable upward trajectory. The stock market of Japan was probably one of the best ways to understand this rise in speculative excesses. Here's a graph with data from the World Bank on the stocks traded in total value. As you can see, there was an insane rise in stock trade in value from 1985 to 1988, the same years when Japan's economy had started to see the effects of the Plaza Accord. In 1985, the total value of stocks traded was just a mere small sum of $455 billion. Yet 3 years later, in 1988, this rose to over $2.54 trillion, and a further increase in 1989 to over $2.61 trillion. But as the graph depicts, there was a crash, a fast crash in trade value the coming year. In 1990, it shrunk to $1.54 trillion. Then further contraction was seen in 1992 to just $606 billion. The value was never seen again until 2004, nearly 2 decades later. The same story can be seen in the market capitalization of listed domestic companies in the country. You can see from the graph right here that from 1985, the year where the market cap of listed companies was just $948 billion, yet it rose immediately to over $4.26 trillion by 1989, and only to come down by nearly half to just $2.25 trillion by 1992. So, was the Plaza Accord the cause of the downfall in Japan? Well, at that time when the treaty was signed, it is worth noting that Japan was actually a willing participant in the agreement. They too recognized the need for global economic rebalancing. Some Japanese policymakers even viewed the accord as a milestone, marking Japan's emergence as a key player in international finance. Hence, if they had accepted this treaty as quote-unquote fair and reasonable at the time, then the question becomes less about the treaty itself and more about the long-term ramifications of its implementation. Secondly, Japan's response to the accord exacerbated its problems. The decision to lower interest rates and fuel credit expansion created the conditions for the asset bubble. Had they arguably acted better, and then the economy may have not stagnated this much. But anyway, do let us know what you think. Thanks for watching.